Right, let's get straight into it. May 14th, 2026, the Navratna PSU NLC India makes a massive definitive market move. We're diving straight into the core catalyst of today's equity research breakdown. Look, what we're looking at here isn't just your everyday sector rotation. No, this is a fundamental re-rating of a legacy state-owned enterprise. Our objective today is to map exactly how and why this transformation is occurring, and we're sticking strictly to the numbers.
Okay, let's look at the hard data. We saw an 18.99% single-day surge that pushed the stock to an all-time high of 387 rupees and 70 paise. Now, when you're dealing with large-cap public sector undertakings, a vertical spike of this magnitude signals a definitive re-rating moment by institutional capital. The market is aggressively pricing in new information, effectively signaling that NLC India simply can no longer be valued through its historical multiples.
So what's driving this? It's the fundamental state of NLC India, which we currently have rated as strong in our latest 365-day equity research report. This strength comes entirely from aggressive execution under Chairman Prasanna Kumar's green NLC vision. The company is pulling off a highly sophisticated pivot, shedding its old legacy image as a pure-play lignite miner and restructuring into a diversified energy powerhouse. Make no mistake, the market isn't just buying current earnings here. They're buying into this entire strategic operational shift.
And this green vision translates directly into concrete fiscal health. While the overall FY26 profit hit a very solid 3,769 crore rupees, the absolute crucial detail for institutional investors is the 100% discom collection efficiency metric. Let that sink in. Historically, a massive overhang on power generation PSUs has been the buildup of unpaid receivables from state distribution companies. By resolving this historical vulnerability and securing 100% collection, management has fundamentally bulletproofed the balance sheet and optimized their working capital.
If we zoom in on just Q4, profit exploded. It jumped 189% year-over-year to 1,393 crore rupees. Explosive growth like that completely validates management's execution, and it's fueled primarily by advanced operational efficiencies at newer units, like the Ghatampur facility. It proves that NSLC's recent capital expenditure cycle is already yielding some seriously high-margin returns.
This brings us to the foundational defensive layer of NLC's business moat, the integrated pithead model. It's a game changer. By pairing captive mines directly with their thermal plants, they wipe out massive logistics costs. In FY26 alone, the Talabira 2 and 3 mines achieved a record production of 19.14 million tons. This gives them unrivaled fuel security and guarantees low-cost power generation, specifically feeding their upcoming 3,200-megawatt Talabira thermal project. It essentially insulates their margins entirely from the wild volatility of global coal markets.
But honestly, that thermal moat is only half the thesis. Let's transition to the green growth engine, which is an absolute masterstroke in value unlocking. I'm talking about the strategic carve-out of NLC India Renewables Limited, or NIRL. By transferring 1.43 gigawatts of green assets into this dedicated subsidiary, NLC is aggressively chasing a 10-gigawatt renewable target by 2030. Having this separate entity allows them to lock down specialized transition financing, perfectly exemplified by that recent €100 million KfW loan specifically earmarked for battery energy storage systems. And the big catalyst? They are targeting a highly anticipated IPO for NIRL in September 2026.
But you'd be wrong to think they're abandoning their baseload. Take a look at the massive 15,000-plus crore rupee EPC contract they just awarded to BHEL. It illustrates the sheer scale of NLC's thermal expansion for the 2,400-megawatt Talabira thermal power project. It highlights a brilliant dual-pronged strategy, aggressively pursuing green capital markets through NIRL, while simultaneously reinvesting heavy capital to solidify their position in India's baseload energy security narrative.
Synthesizing the objective bull case based on all these drivers, the primary catalyst is definitely that upcoming late 2026 NIL IPO. It's going to act as a massive liquidity injection to fund an ambitious 80,000 crore rupee capex pipeline. Second, that pithead model we talked about provides robust cost insulation against volatile global fuel markets. Third, their 600-megawatt CSCI award, which includes solar plus battery storage, cements their leadership in round-the-clock green energy. And finally, peak operations. We're talking unbroken cash flows, record production metrics, and reliable dividend yields. It presents a highly compelling case for sustained growth. However, an objective analysis means we have to counterbalance this with the bear case. First up is ESG exposure. Look, despite the green pivot, NLC retains a heavy legacy reliance on fossil fuels, making them vulnerable to evolving carbon taxes and stringent ESG mandates. Second is execution strain. An 80,000 crore rupee capex plan carries massive debt-to-equity risks and the ever-present threat of mega-project delays leading to massive cost overruns. Finally, fiscal dependencies. Even with current 100% collection efficiency, the company remains structurally vulnerable to any future fiscal deterioration of state discom off-tankers or unpredictable shifts in government PSU disinvestment policies. To understand how these risks and rewards actually materialized, let's map out this transition, starting from its culmination in May 2026, right alongside the record 19.14 million tons of coal production, and the successful integration of the newly commissioned Pachawara South Mine. The most critical regulatory hurdle was cleared. The government officially approved the NRL listing. That approval was the green light that triggered the massive market re-rating we observed at the top of our analysis.
Tracking backward, we can really see the operational acceleration. In March 2026, the 1.4 gigawatt renewable portfolio transferred to NIRL right as the 9 million tons per annum Pachawara South Mine commenced production. And this was the direct result of locking in their thermal future back in January 2024, when NLC awarded that massive 15,000+ crore rupee EPC contract for the Talabira project.
And if we want to establish the true historical foundation of this entire pivot, we have to trace it all the way back to October 2022. That was the moment the strategic shift was announced, moving toward critical minerals and exploring lignite to methanol capabilities. It was a highly forward-looking maneuver, and it was entirely precipitated by the events of May 2021, when a massive post-COVID energy demand surge highlighted the urgent need for robust, diversified, and scalable energy security in the subcontinent. Synthesizing this 5-year trajectory reveals a remarkably methodical corporate evolution, from recognizing that 2021 demand surge to the 2022 critical minerals pivot, locking down thermal baseload in 2024, and finally pulling off the 2026 NIRL carve-out. Management has systematically addressed both domestic energy needs and global capital market demands. That execution has laid the perfect groundwork for the May 2026 government IPO approval. Which brings us to the ultimate strategic question facing institutional analysts and investors today. Can NLC India successfully balance the incredibly heavy capital requirements of its legacy thermal base against a highly ambitious 10-gigawatt green target without completely over-leveraging its balance sheet through an 80,000 crore rupee transition? The underlying data right now presents a company operating at peak efficiency today, but the sheer scale of tomorrow's execution will determine if this Navratna PSU truly becomes the defining green energy powerhouse of the decade.